Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. What a beautiful day. Mr. Tony Shore, I don't know about the weather you've had over there in the Minneapolis, Minnesota area, but I'm telling you what, man, all my listeners and all my viewers over here in Michigan, we just can't believe it. Here we are. We're recording on a Monday.
Yep.
By the time this show airs, it's a week later. It's on Sunday, but the weather has been absolutely amazing over here. And I look at the forecast, and I'm guessing when we record this on Monday, when my viewers are watching and listening on Sunday, it's going to be as nice, if not nicer, next weekend, Tony, than it was this past weekend over here in Michigan. Anyhow, how have you been, buddy? And how's the weather been over there in Minneapolis area?
The same. In fact, this week we're expected to hit a record high by the end of the week. We might hit 80. If we hit 87 or 88, I think on Friday of the week we're recording this this weekend, that'll be a record high for this date in September. I mean, we've had snowstorms by now in the past.
Well, it wouldn't be uncommon for here in Michigan. It's kind of like over there, the weather you get, weather we get. I mean, they say, it's the weather will change. If you don't like it, just wait 5 minutes and it'll probably change, and it'll probably flip right around a 180, right? But I'm telling you, this weather we've had, I mean, the old Indian summers that I can remember as a kid, this is it. I mean, it's just been, it's awesome. It gets down into the 50s at night, which I sleep great.
Nice.
I crack the window open a little
bit.
Cool
and crisp.
I have the fan on and I'm nice and chill. I sleep awesome at night. Yeah. And then, boy, by the time it's, 2-3 o'clock, it's over 80 degrees again. So it's been amazing.
It's beautiful here too.
Yeah, I mean, like today, looking outside, it's amazing here. So, but anyhow,
I was in the 80s today here, and I'm only wearing this because our studio is freezing cold. It's this comes off the second I step outside because it's so warm outside. But our studio, they keep it at you could hang meat in here. I always say,
So you're in the chill zone then.
Yeah, which is fine.
Which is fine. Yeah. That's why they make sweatshirts, right? Get on a sweatshirt or a hoodie. And well, and that's really what I love. I tell my family this all the time. I love the 4 seasons in Michigan. I love the change of the weather.
Yeah, beautiful.
I get really, really excited in April and May when you can finally step out of the house and you can put on shorts, t-shirt, and flip-flops, right? Like that's extremely exciting for me to get out of the winter clothing.
Yes,
and then the second time of year, like the second shift that's really exciting for me is this time of year right here. When
crisp
I go
at night.
I put on jeans, I put on a hoodie. I call it my fall football weather. So when we hit fall football weather and I got to put on jeans and a hoodie instead of shorts and flip-flops, I just love it. I love the shift into the chilly nights.
And then comes the 6 months of winter.
Well, that's right around the corner for us. And, we obviously I don't think we have winter as hard over here as you guys do over there in the kind of in the tundra area, but it does come, right? It does follow generally our December, January, February, maybe even into March can get cold, right? I mean, get down, get chilly and winter and the snow flies. And again, I love that season as well. I really do love all 4 seasons. I love ice fishing with my son Carson and our friends, and I love snowmobiling with family and buddies, and all those things are fun to me at this age. My dad says they used to be fun for him at when he was 50 as well, but now that he's 80, he says, not fun anymore. Don't like the cold, don't like the snow, and when it gets really cold like that. So, but as of right now, I still do enjoy the winter months as well. So. Yeah. But I know we were touching base a little bit before the show, and football season. Here we are. So this past weekend, how did the games go for the Minnesota teams you follow over there, or any of the teams you follow, I guess? And then we'll talk about what's going.
No,
my listeners, I don't know if you could hear that. It sounds like rocks shaking in a bowl.
That was me shaking my head. Rocks shaking in a bowl.
Tony was just shaking his head. No. So I'm guessing, Tony, and honest to God, I don't know how the Vikings came out, but I do know obviously Tony's a big Vikings fan being out of Minneapolis. But by the way you were shaking your head, not such a good weekend for the Vikings.
No, I mean, we almost came back to tie it. It was very close in the final few minutes, but we played horrible.
Did you?
We played a good first series and a good last couple series, but other than that, we played horrible. So, it was a tough one. It was a tough loss. Yeah.
Well,
tough loss.
I like to say whenever we're talking about like Carson playing baseball or football and what have you, I always say we got to remember they're kids, right? They're only kids, because I get disappointed and upset when we lose, and so. But here I am thinking I can't say that because these guys are professional athletes. These guys are anywhere from 18 to 30 years old. They're making millions and millions of dollars. The coaching, I mean, it's just amazing what goes into these college teams and these professional teams nowadays. And so you can't use the old terms. Well, yeah, they're just kids. They lost another one maybe next week. I mean, that's frustrating. I mean, it is frustrating. We were there for years and years as Lions fans, as you know. We've been very fortunate the last few years to have a pretty darn good team, a pretty solid record. We pulled out a really big win yesterday against the Browns, and so we're on a roll. 3-1. We came out the very first game of the season, and a lot of us over here, we kind of think that was our preseason game because none of our starters played, or not very many of them anyhow, in any of the preseason games. So that's pretty tough when your starters don't play. And then you go into the first game, and the team you play against, their starters did play in their preseason games. And so you're kind of a step behind. And so that's what everybody, us Lions fans, we talk about is really our first game was kind of our preseason starter, our warm-up game. And obviously we fell behind the 8 ball. We didn't do so well, but ever since then, boy, our Lions have been rolling. We're up, 3-1 in the record right now. And I haven't looked at the schedule. When do we play those Vikings? When is that matchup?
Is that matchup?
Is that in 2? I think that is in 2 weeks. I was actually going to travel over there. I know a good buddy of ours, Albert Lalonde, who's another advisor out of the Detroit, Michigan area. He's actually traveling over, and I think Rob Rumsberg, who's a employee of Gradient Investments, he may be going to the game over in Kansas. Oh, I'm sorry, I'm thinking Kansas City. I'm sorry.
You guys are playing Kansas next week.
Yeah, on the 12th or whatever. We play
the 12th.
Okay. I'm sorry. I was confused. It was for my viewers and listeners, Gradient Investments. If you're familiar with that name, and you should be, that's Tony Shore is employed by Gradient. We've had Gradient Investments portfolio manager on the show quite often. If you are one of our clients, Gradient helps manage some of your money. They have offices in Minneapolis, Minnesota, and down around the Kansas City, Kansas area. So we have dual fans. We have Minneapolis Vikings fans. We have the Kansas City Chiefs, and so it's kind of tough.
Of course, you and your staff and your clients, Lions
most
fans.
Most of us are Lions fans.
I looked it up. The Lions are going to lose to the Vikings on November 2nd. That's the game date. That's the
listeners, viewers. Did you hear that? Did you hear that bold statement from Mr. Tony Shore? Tony, I'm going to use the saying. I think Carson probably taught us this. He says, "Hey, put your money where your mouth is, Mr. Shore." And if my listeners remember, last year, Carson took $5 from Mr. Shore.
Yes, he did. He took my money.
I'm going to speak for Carson, he's not here. So, Mr. Shore, put your money where your mouth is. If you're so inclined to say that the Lions are going to lose to the Vikings, I would love to see you and Carson go another bet, $5, you and Carson. Who comes out on the upper end for that game against the Vikings and the Lions? And what's the date of that again? On the 2nd, November 2nd?
Yeah, November 2nd. I want to pick his dad's pocket a little more. Let's go 10. $10 and straight up. I won't even need the points, which you guys will be favored by like 21. By that time, probably 21 points. So, but nope, even matchup. Whoever wins. Whoever loses.
Okay, so
loses.
Just winner. Don't have to go point spread or anything.
Winner. And we're not encouraging gambling, or especially for children to gamble. But yes, you tell Carson to $10.
All right, double or nothing from last year's bet. Him and Mr. Tony Shore. We're not gambling. Nothing going on here. Just a friendly wager against some family here. So that's awesome. I'll be sure to tell him, Tony. Yeah. Hey, how's everything been going over there? I know, obviously crazy time of year. Can you believe it? In a couple days here, we're going to say the O word, October.
Yes.
It's October.
When this airs on the radio, it'll be October.
It'll be October when this airs. Can you believe it?
No, I can't. It'll be a few days into October, actually. And that's just crazy, right? I think that's nuts.
It really is.
October, Halloween is right around the corner. And the crazy thing is I went into a Lowe's, like a Home Depot, and they had all the Halloween stuff or all the Christmas stuff out.
That's crazy.
I went into a couple stores and it's just packed with Christmas stuff.
Oh, it's too early. Too early for that, Tony. I don't like when they get started. My thought is they shouldn't be able to put up decorations or what have you, or stuff in the stores until the month of or 30 days, no sooner than 30 days before.
Oh, so, wow, you're 30 days.
I would think so. I mean, allow us to get through Halloween right now first, and then Thanksgiving. And then we can go for Christmas, right?
Used to be. I'm even willing to say, hey, if the stores want to start putting out Christmas stuff a week after Halloween, but give us Halloween, give us a week, at least a week or two reprise, then you can start putting out Christmas stuff.
Well, it's crazy. They start 3 to 6 months in advance now.
I know and it gets worse every year. That's what it's like, you talk about lifestyle creep with your expenses and people's finances.
Oh, yeah.
That's a problem people have, lifestyle creep, bigger house, bigger car, spending more, but not necessarily in relationship to their income. And that can be a problem during your working years, let alone in retirement. That would be a huge issue. So, but they have this holiday creep, retail holiday creep, I call it, because and I'm not just talking about holiday creep like Halloween. I'm talking about it creeps up earlier and earlier. They start putting Christmas stuff out, and I start hearing Christmas music earlier each year.
Yeah, and it seems like Christmas is the main holiday that usually, you're right, they creep out a little sooner every year.
Yep.
And so it's crazy.
So the most money, people spend the most money on the Christmas holiday of any other holiday, but a close second is Halloween. That's the
Halloween.
Second.
Isn't that something?
Yeah, isn't that something?
Decorations and
Halloween decorations and costumes. It's gotten crazy. Yeah.
Well, that stuff's not cheap. They don't wear the old plastic masks and capes like you and I used to wear.
Oh, no. Yeah. Remember those with the stretchy string and the hard plastic that
hard
crack
plastic if you cut your eyes and cut your mouth. And
you
couldn't see out of it anyhow. You tried to cut new eye holes.
Yeah. Yep.
Like the
been there, done
that. For a cape. Oh yeah.
Yeah. Oh yeah. Been there, done
kids
that.
Got it. So kids got it.
Oh, the kids these days. Listen to you and I. The kids get off my lawn, right? These kids today with their video games and their pacemakers, Jason, I can't keep up with them. Well, hey, we're going to take a moment here to let our listeners know how they can get a hold of you if they have any questions during the show. And then we're going to start the topic, and you're going to talk about the hidden key to successful investing and investments. I think that's great. Can't wait to hear about that and what it is. But first, listeners, we're giving away 10 copies of Jason's book called Empower Your Retirement. And Jason is offering a no charge, no obligation consultation. Just be one of the next callers. The first 10 callers get a book. And if you want to set up a consultation, you'll also get a book. And there's no charge, no shipping, no obligation. Just call 989-835-7203. And you have to mention that you heard about it on the show, whether it's YouTube, podcast, or radio. You heard about it on the radio show. 989-835-7203. And this is your Financial Empower Hour. I am your co-host, Tony Shore, here with our host, Jason Cryderman. Jason, where do you want to begin? So what's the key to successful investing?
Yeah, I thought that was a really cool title when we talk about the key to successful investing. And what a tagline. And as I did more research and reading into some of the articles and resources that you and I talk about before the shows, I really narrows down to a 4-letter word. And usually 4-letter words, we stay away from, right? When you hear the 4-letter word, we think, oh boy, what's coming out of his mouth next? What's coming? Wait, we're on the air. We can't say that. Well, it is a 4-letter word, but if you manage this 4-letter word properly, you will have a very positive, powerful impact on your money, whether you're just starting out investing, you're in the middle of your investing career, or you're towards the end, you're getting into or enjoying an awesome retirement. And that 4-letter word, Tony, is the key to successful investing, is risk. R-I-S-K. That 4-letter word is very, very powerful. It can be very dangerous if not if not taken into consideration properly. But it can also be very, very powerful and opportunistic if taken into consideration appropriately for whatever phase you are in your investment career. So we're going to talk about risk today on the show, and it's really that four-letter word. And I want to help my listeners and help my viewers not have a negative connotation or a bad experience with that four-letter word. A lot of those four-letter words, yes, they're negative, they're bad, we don't like to hear them, we don't like to say them. It's unfortunate. Well, we're going to take this four-letter word risk, and throughout the show today, Tony, we're going to talk to my listeners and my viewers about how they can turn a potentially very ugly four-letter word into a very positive, powerful opportunity for them when it comes to their portfolio.
Right. So, I know people focus on returns when it comes to investing, but you're right. Risk management is where it's at. So I know you want to talk about risk management today. And what does risk management mean? Let's all get on the same page.
Yeah. So first of all, people think, I want to avoid risk. I have to avoid risk. Well, that's not really what management means. That would be risk avoidance. Okay. And that's a totally different term, totally different concept.
Which is hard to do because almost any type of investment that's going to earn you any kind of interest is going to have some risk.
Absolutely. I mean, anything from
one way or another.
Think about the safest. Well, I can bury it in my backyard, or I can put it in a safe at home or in my freezer, right?
Right.
My grandpa used to do that. And matter of fact, where they got the term cold cash. Cold cash, I heard from my grandpa, they got that term when they used to put their money in a baggie and put it in the freezer so that if the house ever burned, what doesn't usually burn in the house? The freezer.
So my great-grandfather did that. I remember my great-grandpa had cash in bags in the freezer. So that's why as kids, when we go, is there popsicles in here, and open it? Don't open that. Don't look in there.
Don't open that brown
bag. You have to ask for permission to go into the freezer. I'm like, wow, why is this freezer so important?
Pretty strict grandpa.
and then my mom showed me that's where your great-grandpa keeps cash.
Keeps the cash. So that's for the term, the cold cash, cold hard. But anyhow, I mean, let's say we kept money at home in the safe or in the freezer. Well, you're losing purchasing power, right? There's risk to that. You're losing maybe inflation to earn something. Well, then people say, gee, I'll put it in the bank in a CD or in money market or those types of accounts. Well, you still have some inflation risk. You have interest rate risk because that interest rate could go down on you, which as of recently we've heard and we've seen Feds lowering interest rates, and they've talked about lowering them more in the future. So we lose purchasing power there as well. And if it's money not inside of an IRA or a Roth, some form of tax advantage or tax-free account, there could be taxes as a risk on that money. If we put it in a CD and we do earn 3%, well, we take on taxation as well. So the true net return of those gains is not really 3%. So there are a lot of risks, even when people think of safe money. But again, as you pointed out, risk management doesn't mean avoiding risk. Risk management, because every investment has some form of risk, but what true risk management means, Tony, is identifying risks. Identifying where is my interest rate risk? What is it? Where is it? What about the stock market? What about international? What about inflation? All those different types of risks, taxes and fees. Those are all different types of risks that you could see within your investments in your portfolio. We don't want to avoid them all. We need to identify what are they, where are they, and then we need to properly manage them, meaning spread them out appropriately for you and what phase of life you're in and what your goals and objectives are. And every one of us out there is going to have different levels of risk. Some people are going to have a higher tax risk than others, and that's okay. Some people are going to have more of an interest rate risk or more of a stock market risk or maybe more of a taxation, and that's okay. It's very important that you don't just do what your neighbors are doing or do what your buddy at work or your sister or somebody is doing because that's what they do. Again, identify this risk for you of what's appropriate, spread it out, and have strategies in place so that no single event derails your goals. So you don't want all your exposure and all your risk to be the stock market, because if the stock market corrects itself 15, 20, 30% or more, you had 100% exposure to that one risk, and that could potentially derail your portfolio. That could derail your goals and dreams. That could derail retirement.
Yeah.
So that's important, Tony, to point out that risk management, again, doesn't mean avoiding risk, because every investment does have some form of risk. It means identifying the risk, spreading out the risk, and have strategies in place so that no single event can derail your goals, no matter what phase you are in retirement or in your financial planning if you're not at retirement yet.
Yeah, there you go. Well, hey, we need to take another quick break to let our listeners know how they can get a copy of your book. It's called Empower Your Retirement. And I can't believe it, Jason, you and your team are so kind. You'll mail these out, no charge, not even charge postage, for the next 10 people who call in and request a copy. All they have to do is call in whenever they're watching this show, however they're listening to the show, and whenever they're listening, call in and see if you're one of the next 10, or if there's any books left available. But you have to mention you heard about it on the show. You heard about it on your Financial Empower Hour. That phone number is 989-835-7203. That's 989-835-7203. And if you want more information, go to GreatLakesInvestmentAdvisors.com and check out all the great resources there. Speaking of risk management, when we come back, we'll talk about what you can do on the website to get started on this. All right. This is your Financial Empower Hour, and I am your co-host, Tony Shore, here with our host, the man with the risk management plan, is Jason Cryderman, and we all need one. We all need an overall plan to help us with risk management. What are some tools that people can use or that people need to know about for risk management?
Yeah, we're going to dive right into that real quick. But before I think it's very important, Tony, you point out, you just mentioned that P word, right? That's another four-letter word that some people, if you don't have it, this could be a potential problem. But if you have it, this could set you up very, very well for retirement planning. And that four-letter word is plan. Yep. You need to have a plan. And don't just fly by the seat of your pants. And just simply having investments is not a plan. You need to have a plan. You should have a risk management plan. You should have a fee management plan. You should have a tax management plan. You should have an interest rate and inflation management plan, maybe a guaranteed lifetime income plan, and an overall tax reduction plan, asset protection and longevity plan. All kinds of these mini plans is what we call them, should go into your overall wealth management and retirement income plan. And whether you're just starting to invest your first $5 or you have $500,000 or more, you should have a plan. And everybody's plan will be different. And so I think that's important to point out, Tony. So thank you for bringing up that four-letter word, plan. Again, without one, it could be scary and dangerous four-letter word. But having a plan, being proactive, put yourself in a very fortunate, opportunistic position where you don't have to worry about the negativity to that four-letter word. Yeah. So let's talk about the tools for risk management. Because again, a part of every single plan that I build for the families I manage money for is risk management. We're going to have an interest rate risk, an inflation risk, a stock market risk, a bond risk, you name it. There's a lot of risk that we try to prepare and plan for. And three main keys or tools for risk management are diversification, which means don't put all your eggs in one basket. Spread your money out across multiple stocks or bonds or real estate, different sectors, different investments. So we don't have all our eggs in one basket. Number two is asset allocation. What asset allocation means, Tony, is have the right mix depending on your age, your goals, and your comfort level. Again, allocate it. How much money do you have in cash, bonds, or other fixed income investments? How much do you have in U.S. stock? How much do you have in international stock? How are you allocated across your portfolio? And this will be different based on your age, your risk tolerance, your income needs. It'll definitely be different than what everybody else around you is doing. So don't get caught up in just investing the same amount in the same stuff that you heard other people are investing in, because that may not be what's really 100% in your best interest. And then that third tool, Tony, for risk management is safety nets. You got to have safety nets built in. We say plan for the best, but prepare for the worst. How do you prepare for the worst? You build in some safety nets, things like buffers. There's certain investments out there that are securities. They're in the market, so they have great upside opportunity, but they're what's called a buffered index portfolio. So they have some or 100% downside protection. Those are pretty darn cool. That's a safety net. Yeah. Or you can build in some form of fixed or indexed annuity. Again, good upside opportunity, but no risk. So that's a downside buffer, a downside protection from risk in the portfolio, or even just keeping cash on hand for opportunities in emergency, whether it be cash in a money market, cash in the safe. It is a good idea to have some, even here in the banks. I call it local and liquid. Maybe 3 to 6 months of expenses, local and liquid. It doesn't earn a heck of a lot, but it's local, it's liquid, it's emergency money, it's opportunity money. So those 3 tools for risk management, Tony, that we talk about in every single financial empowerment plan that I build is diversification, asset allocation, and safety nets.
Yeah. Yeah. Well, and I have a question for you. Why does risk management matter?
That's a great question. It's an interesting question. And it's a question I get asked quite often is, why do you focus so much on risk? Why does this matter? Well, if you take on too much risk, one market downturn can set your retirement back years, whether you're in your 20s, your 40s, your 60s. Think about 2008 when the stock market fell over 30 to 40%. If you were 1 year from retirement or your first year into retirement, that was devastating. That either put off retirement or put a lot of people back to work. So don't take on too much risk. You got to be able to identify how much risk exposure I have so you don't take on too much, because it could be a major downturn at the wrong time. The flip side of that coin, though, is if you take on too little risk, inflation can eat away at your savings. I mean, look back.
Inflation is a huge problem.
2 years ago, inflation reared its ugly head, got over double digits. And if you weren't prepared for that, or at least adjusting along the way after it happened and taking on a little more risk or being prepared, boy, inflation can eat your savings away and take away the horsepower of the purchasing power of your money. And then really the sweet spot is managing the risk so you stay invested for the long haul. So we should have a little bit of risk for the stock market, but not too much. We should have a little bit of risk for inflation and interest rates, but not too much. So again, it's finding that sweet spot. We have to be able to identify where are the
balance.
Yes, where are the risks? Identify that sweet spot and build a balance that makes sense for you, whether that's a 70-30, 50-50, 30-70, whatever that might be.
Yeah. So, and that brings us to the emotional side of investing. I wanted to ask you about that because I think this is where a financial professional earns their keep. Someone like you, a financial services professional, who's a fiduciary, who's got your best interests in mind and looks at the big picture to keep people from making emotional decisions, because the majority of people who do their investments on their own end up buying high and selling low because of emotions, right?
Yeah, I mean, that's the number one golden rule of investing is to buy low, sell high.
Yeah.
But it's statistically proven that time and time again, individual investors, even some stock portfolio managers, we end up doing the opposite, where we buy high and sell low because we're chasing numbers and we're looking at the great companies and the great returns. And we want a piece of that pie. So by the time we buy, the next day things turn around. So yes, emotional side of investing, taking the emotion out of it, taking the heart, the adrenaline and the flutters. Do I buy? Is this one I buy? Do I sell? How much? Take all that emotion out. And now when we entrust in third-party wealth managers, that helps take the emotion out. They have algorithms built and designed to show them when our buy signals, when our sell signals, when our hold signals, as well as how much for each of those signals. But risk management isn't just about the numbers. It really helps keep emotion in check. So if you have a plan that says, I'm going to allow myself to be exposed to X, and if X plus happens or XY happens, I'm going to be prepared to do this to reduce or increase my exposure, whether it be positive or negative. If you have a plan and you stick to the plan, it helps take all the emotions out of check. So when markets dip, having a plan makes it a lot easier to stay calm and avoid panic selling, because the last thing we want to do is sell low. We actually want to buy low, which is hard to do when we get emotional. When things go down, we want to get out, but that's not how we make money. Remember, we're supposed to buy low, sell high. And that's also hard to do, is sell high, because when those are our winners and we're up 20 or 30% emotionally, how can we get rid of our winners? And if I get rid of my winner, I'm supposed to go buy a loser because I'm supposed to sell high and buy low. Take the emotion out of investing. Generally long-term, you'll end up with a lot better returns, a lot better portfolio performance in the long haul.
Yeah. Well, and that makes sense. And so in light of that, we want to avoid emotional investing. Part of that stems from everybody's risk tolerance is different. And so when we talk about risk tolerance, talk to us about that a little bit, because you have a tool called the Color of Money Risk Analysis, or the COMRA, that you use. It's just a little 11-person quiz that you have your people that you meet with take.
Yep.
So you can get an idea, right, of where they're at.
Yeah. And that color of money. So any of my current clients that are hearing Tony say that, you probably, oh yeah, the yellow money, green money, red money. We know what that means, right? Green money is safer. Yellow money is managed with some level of risk. Red money is a lot more risk, maybe even money that I'm not managing, like a current 401k or something. But we have a quick questionnaire. I think it's 10 or 11 questions, as you mentioned. It's called the Color of Money Risk Analysis. This is really interesting, Tony. So we find a lot of people come into us, and maybe they're referrals of friends or family members, coworkers, and they say, oh yeah, I want exactly what Jim has. I want exactly what Susie has. And so then we have them take the risk tolerance questionnaire. And that basically, it's 11 questions that are going to get inside of your mind and your gut and how you feel about making money, and more importantly, about losing money. And more times, 9 out of 10 times, I should say 10 out of 10, when someone comes in and says, I want what so-and-so had, after they take the risk tolerance questionnaire, they have a totally different risk tolerance. So they should not have the same stuff. So again, it's really important to have a plan, custom tailor your plan, identify your risk categories. Where's interest rate risk? Where's inflation risk? Where's fee risk? Where's stock market risk? Where's taxation risk? As well as identify your goals and what are the opportunities out there in each of those areas for you to accomplish your goals with the highest probability of success. And usually accomplishing those goals with the highest probability of success is because you can manage and mitigate the risks to the best of your ability. These things don't just happen overnight. You know this, Tony. My viewers and listeners know this. I probably got people out there shaking their head right now saying, he's absolutely right. I don't know how to do it. It doesn't happen overnight. I'll tell you how. Get a plan. Have a plan, whether you do it yourself or you entrust in a fiduciary advisor like myself, another member of my team, or another advisor. Have a plan. Stick to your plan. Don't be afraid to review on a quarterly, semi-annual, annual basis. Review your plan and make appropriate changes. Update your plan. It's okay to make changes. We make changes in plans all the time because life changes, interest rate changes, stock market, risks change, goals change. It's okay. But again, if we don't have a plan, how can we even assess what we're doing if we don't know where we're starting from?
Yeah, I think that's huge. And so I have a question for you, Jason. How can our listeners out there take that Color of Money Risk Analysis, that 11 questionnaire that you have, and figure out where their risk tolerance is at versus where their finances and investments or 401ks are actually at? You can run those reports for them, correct?
Yeah, absolutely. So the first step is to take that 11 question, as Tony mentioned. It's called the Color of Money Risk Analysis, COMRA. It's real quick. You can go onto my website, GreatLakesInvestmentAdvisors.com. And if you scroll through there, there's a place to take the COMRA risk analysis, or simply call the office. Just let one of my staff members, my team members know, hey, I want that Color of Money risk analysis. There's no charge for it. We'll email it to you. You can stop by the office. We'll print you out. You can walk out with it in about 3 to 5 minutes. Take that analysis, and that will help you find out where you are. Because what it does, Tony, is it takes those 11 questions, and based on your answer, it gives them a numeric score. And when you add up all those scores, you're going to find out, hey, I'm in the conservative mindset, meaning how I think in my mind and in my heart and stomach about losing money, I'm conservative. Or maybe I'm moderate. Or maybe I find out I'm aggressive. Well, you need to take the answers to that, the COMRA. Are you conservative, moderate, or aggressive? And then you need to align it up with how are you actually invested today? And I would say probably 8 out of 10 times, Tony, over the last 23 years, when I've had investors take this COMRA score, they do not align with how they think and feel the answers of their score, how they think and feel in their heart and their minds about making and losing money. It does not align. It doesn't align with how they're invested. We find there's a disconnect where either They want to make more money. They like risk, but they're invested conservative or moderate. And then they wonder, why the heck, when the market goes up, am I not doing as good as I should be? Well, your money's not aligned with how you're thinking and feeling and what you want. Or the flip side of that coin, and let's talk about the 4-letter word, risk. The flip side of that is a lot of people take the COMRA and they come in as a moderate investor.
Yeah.
However, then we take a look at their current 401ks or their current portfolio, and they're invested as an aggressive investor. Well, there's a huge disconnect. And that's when people say, gee, when the market went down 20%, why was I down 25 or 30? You were taking on more risk than you were comfortable with.
Yeah.
And again, this is something we have a lot of our clients do on a quarterly, semi-annual, annual basis, is retake the exam, retake this little COMRA. It's 11 questions. Why? Because things change.
Yeah.
And then take a look at how does that align with your portfolio? Because not only do our thoughts and feelings change, but our investments change daily as well.
Yeah. Yeah. And so if our listeners want to set up that consultation, there's no charge, there's no obligation to take that color of money risk analysis and get a report run to see where you're actually at. All they have to do is pick up the phone, give you a call, 989-835-7203. That's 989-835-7203. All right. And on your Financial Empower Hour today, we've been talking about the hidden key to successful investing, which is risk management. And we've touched on a lot. Maybe for before we go today, you could just give us a quick recap on why risk management matters in investing. Why is it the hidden key to successful investing?
Yeah. So identifying your risk and proper risk management truly is the hidden key to successful portfolio management, to successfully making money, to successfully not losing or giving away too much money. So we're going to talk about that 4-letter word, risk.
Yep.
Risk management does not mean avoid risk. Risk management means identify where risk is across multiple spectrums, and then properly manage that risk based on your goals and objectives.
Yeah.
Okay. So that's what risk management means. And first of all, so there's really 5 keys that I'll kind of touch on here before we go today. Number 1 is protect your downside. Investing always carries risks. The markets can drop unexpectedly. They can drop drastically. You need to be prepared for that. Remember our tagline, plan for the best, prepare for the worst. If you don't identify your risk exposure, how can you be prepared if the market falls that you're not overexposed? Risk management tools like diversification, asset allocation, and buffers or hedges, Tony, also help limit potential losses so that one bad investment doesn't sink a whole portfolio, or one bad week or month. So you want to make sure you're diversified, proper allocation, and use buffers or hedges like those buffered index portfolios, maybe fixed annuities, maybe index annuities. Those are different types of investments that we help our families with to mitigate some of their risk exposure to the stock market. Keep our emotions in check. We already talked about that, Tony. It's tough to do. Everybody's very emotional. But if you keep your emotions in check, meaning don't let your emotions get the best of you, without a plan, market swings can trigger a lot of fear and a lot of greed, a lot of adrenaline, a lot of heart pumping, a lot of scared. Oh, I don't want to lose any more money. I'm going to sell. Or, oh my gosh, I want some of that. You get greedy. And check your emotions at the door. A risk framework helps investors stay disciplined and avoid costly emotional decisions, Tony, like panic selling or chasing hot stocks, right? Buying or selling at the wrong time, which your emotions most of the time will force you to do. So we try to keep your emotions in check. Number 3, balance growth and safety. So the goal isn't to avoid risk altogether. Remember that, Tony. The goal is to take the appropriate amount of risk when it comes to inflation, portfolio, interest rate, taxes. So you take on the right or appropriate amount of risk for your goals, nobody else's goals or objectives, appropriate amount of risk for your goals. Retirees need protection and income stability. And, when you're younger, a younger investor, you might be able to accept more volatility for longer term, but older investors generally can't. So remember to cater the amount of risk to your goals and objectives. Kind of going along with plan for the best, but prepare for the worst. Tony, Proper risk management helps prepare you for the unexpected, such as economic shocks, recessions, interest rate changes, or geopolitical events can hit the markets anytime. I don't know if any of our listeners or viewers or you, Tony, think right now, could we think about our market and economy today? Think about the world. Think about how we are social. Economic shocks, recessions, interest rate changes, geopolitical events. This is a crazy time we're living through.
Yeah,
you need to have a plan.
Yes.
You need to identify all these levels of risk, and you need to be prepared. Plan for the best, but prepare for the worst with proper risk management. And number 5, the last one we'll leave with today, is supporting your long-term success. I mean, how can you really make sure you have the highest probability of success long-term if you don't plan, if you don't properly take a look at where are all these potential risk exposures and what can you do to put yourself in the best position? Consistency is the secret to wealth building. So be consistent, identify those risk exposures, manage those risk exposures, review those risk exposures, and don't be afraid to change, because managing risk will definitely reduce your chance of big setbacks that could derail investments as you're just getting started or an overall retirement plan, no matter what your investment timeline.
There you go. Well, great stuff today, Jason. Listeners, give Jason and his team at Great Lakes Investments a call. That's 989-835-7203. Again, call and set up a no-charge, no-obligation consultation, 989-835-7203. And that does it for today's episode of Your Financial Empower Hour with our host, Jason Cryderman.